welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
This has been a growth stock that's stopped growing, and so what the company really needs is an incremental growth driver. The Cybertruck has been incredibly disappointing as an incremental vehicle, and so they're trying to refresh the product suite. And part of the issue here is that they've saturated demand on the Model 3 and the Model Y. They've been huge successes, but the next leg of the story has to be this lower cost vehicle.
The idea that TikTok will be banned fully has not really registered yet, in my opinion, in marketers' mind. But even if it happens, because Instagram and Facebook, which is Meta essentially, adapted to the vertical format of video, the idea is a lot of those same users and influencers will move to Facebook and Instagram.
We heard some encouraging remarks from Dave Calhoun this morning. The company's still looking to draw down its inventory this year, which is good. They're still planning to acquire Spirit potentially this quarter, which is, I think a positive. And they're sticking by their $10 billion free cash target in 26, which is surprising. But I think it, speaks to their confidence in the ability to right the ship.
We've got 1 hour to go until the market close. Let's take a look at the major averages sponsored by Tasty Trade. We've got not much change in the Dow right now, kind of a zigzaggy kind of session here. Down about 93 points at the moment, about 0.25%. The S&P 500 down about the same, 1/5 of 1%, as is the Nasdaq. If you take a look at what's going on sector-wise here, we've got the Nasdaq there, but just looking at the sectors here, we've got industrials that are doing the worst today, followed by communication services, utilities, and consumer discretionary are on the rise. But really what you have here is a story of individual movers rather than a big macro theme that's affecting stocks in today's session. Going back over here to our major averages, I want to take a quick look at trending tickers, actually, just to give you an idea of what our users on Yahoo Finance are watching today. And we're going to talk much more about them in just a minute. But if you look, Meta is the top trending ticker here. It's going to report earnings after the close of trading. Tesla up 11% after its earnings, which disappointed, but moving up the timeline potentially of the so-called Model 2. Boeing trading down. You get the idea here. In other words, we are seeing investors turn their attention to individual stocks based on earnings that have reported or earnings to come. And on that, I'm going to send it back to Josh.
Thank you, Julie. We've got some big earnings on deck after the bell today. And one of those names, Meta, the company stock riding high well into 2024. Here with a preview of what to expect from today's results, Dan Howley.
Yeah, you got to strap in for this one. Obviously, this is coming off of Meta's huge prior quarter where they had seen their share prices rocket following the announcement that they're going to have a 50-cent per share dividend and then announced that they were increasing their share buyback by $50 billion. We'll have to see if the kind of momentum that we've seen from Meta will continue to move forward into this quarter and the quarters to come. There's been some talk among analysts about difficult comparisons to the prior year quarters, especially when we saw the digital ad market really start to pick up again after the slowdowns during COVID and when Mark Zuckerberg did his kind of year of efficiency. Part of the conversation is going to be about how they're dealing with AI and how that is enhancing ad sales, if it's enhancing ad sales, the kind of work that they're doing there. Obviously, this month they announced their new Llama 3 large language model, as well as their Meta AI chatbot. And that's been kind of met with mixed responses now. Some people upset that they can't turn it off. Some people seeing strange responses to it. It joined a Facebook group for mothers in New York and claimed that it had a child in a school district. So kind of weird things there. And then we also saw Mark Zuckerberg announce that they're going to open source their operating system for VR headsets. That's the Horizon OS, meaning that we'll start to see more manufacturers get into the headset game. We'll just have to see if that means that more people will start buying headsets, though.
And speaking of headsets, by the way, even as we see that company, Meta, try to push forward its various headsets, there are some reports about Apple's Vision Pro from the very closely watched analyst Ming-Chi Kuo, saying that the company has cut orders for the Vision Pro. What can you tell us about that and sort of contrast it with what we're seeing from Meta?
Yeah, I mean, Ming-Chi Kuo obviously is a well-known Apple analyst. I mean, he's up there with some of the best when it comes to recognizing what Apple's doing and getting the inside baseball on it. And so, him coming out with this is a kind of obviously a big hit to Apple if it's true that they actually are cutting back on orders because of response from consumers or perhaps a lack of response from consumers. I think, the Vision Pro at $3,500 was never going to be a volume seller. It's not going to be an iPhone. It's not going to be an Apple Watch. Even those among themselves are relatively expensive, but they have clear purposes that people want, whether it's the iPhone, it's your smartphone, it's everything, your digital life now, and your smartwatch, which, helps with everything from being able to get notifications to fitness. So, when it comes to the Vision Pro, it's still, the jury's still out onto what the clear purpose is. There's the productivity standpoint, which is good, but, do you want to wear a headset while you're working all day? Movies look great on it. Do you want to wear a headset while you watch a movie? There's still this kind of disconnect with consumers. So when it comes to Meta, they're clearly going all in on this. You have to imagine that Apple's going to stick this out, though. Remember, the Apple Watch wasn't exactly a huge seller right out of the gate either.
Yeah, the answer on do I want to wear a headset all day at work? That's a no. Do I want to wear a headset when I watch a movie? That's a no. But maybe that'll change. Dan Halley, thanks a lot. Appreciate it. Also on deck to report first quarter results, Ford. Yahoo Finance's Pras Subramanian is here with the details of what to expect there. Hey, Pras.
Hey, Julie. Yeah, so, big picture looking at revenue of $40 billion for the quarter, a result that's actually 3.5% lower than a year ago, with adjusted EPS coming in at 42 cents a share. Now, this all comes behind the backdrop of strong Q1 sales results, with overall sales up 6.8%. They reported this earlier this month. What actually hybrid sales hitting record, and EV sales actually up pretty strongly too. Now, Ford, as we know, is pivoting and delaying some EV spending and vehicle launches, EV vehicle launches, pushing forward with hybrids and other gas vehicles until the EV market matures. But in the meantime, investors are looking to see if Ford's strong current sales will lead to a boosted profit outlook following GM doing the same only a couple days ago.
Pras, thank you. Appreciate it. And Chipotle also gearing up to report after the close. Yahoo Finance's Brooke DePalma joining us here with more. Brooke.
Good afternoon, Josh. I mean, certainly Wall Street is expecting another positive earnings report from Chipotle. Chipotle shares up 31% year to date so far. So another positive report expected after the bell today. To break down those estimates, the company, Wall Street expects revenue to come in at $2.67 billion. Now, that's about 13% higher than last year. Adjusted earnings per share also expected to grow year over year, coming in at $11.66, up 11% from last year. And same-store sales expected to jump roughly 5%. Now, some key points that Wall Street is watching for in this Q1 report includes that resilient foot traffic. What Wall Street really expects here is that consumers continue to seek the throughput, the quick service that Chipotle continues to provide, and also ultimately the best bang for their buck. Chipotle continues to have this value perception, with the average bowl costing about $9. Now, another key point that Wall Street is looking out for is innovation. They're looking to see if there was a potential boost from limited time offerings that they actually brought back. These two favorites, including carne asada, which lasted until the early part of this quarter. And then they brought back the chicken al pastor. Now, it's important to note here that these two returned fan favorites do have a premium price point, and so it'll be interesting to see just how well they did in this past quarter. The last key point that Wall Street is looking out for is any impact from that California FAST Act. We do know that that went into effect on April 1st. That increased the hourly wage there to $20 per an hour. Now, it's worth noting that 14% of total locations for Chipotle are in the state of California, and so many eager to hear just how much menu prices were increased to offset that labor inflation. Sharon Zakfia of William Blair suspects it's around 7% of a price hike within California.
All right, thank you, Brooke. Appreciate it. Stocks lower today as earnings season is now in full swing, and investors have their eyes set on big tech. Tesla, of course, kick-started it for the Magnificent Seven on Tuesday, setting the table for another wave of reports after the close today, including another Mag 7 name, Meta. For more on what we've seen thus far in the earnings season and what we can expect moving forward, we welcome in Michael Kentrowitz, Piper Sandler Chief Investment Strategist. Michael, it's good to see you.
Thanks for having me.
So after the bell, earnings parade continues, Michael, right? Got Meta, IBM, Ford. What have you learned so far this earnings season, Michael? What have been kind of your big takeaways?
Yeah, well, we came into the earnings season with a fairly low bar. We look at how many companies pre-announce before earnings season, and that's been trending higher for several quarters and hit a new cycle high, roughly a 3 or 4 year high across large, mid, and small caps before the quarter. So that means the analysts have kind of already lowered their estimates coming into the season. The odds of beating perhaps are a little easier. And so we've seen exactly that. So far, about 100 companies have reported. We'll get a lot more today. Most of them have beat. We look at every quarter stocks that are most likely and least likely to miss earnings. Many of the companies that have already reported to date are on the most likely to beat, and they indeed have. So I would say, just with a little caution, the bar has been lowered, but also don't extrapolate this quite yet.
Mm-hmm. So in other words, are we going into a period where the bar is higher and it's going to be tougher to beat?
Yeah, incrementally, and there is again a little bit of a seasonality within earnings season. The first 100 companies just generally have a higher history of beating.
Why is that?
It could be because of the industry mix that first starts earnings and how they can better get the street to where they want it to be before earnings. And then as we go forward, looking at the stocks that we think are most likely to miss, and these are companies that have a history of missing, companies where earnings expectations are very really dispersed or wide, uncertain, and companies that are very cyclical. More of those are yet to come, and so I think things will kind of even out a little bit.
What's Michael, right now, what's your year-end target for the S&P 500, and what are sort of kind of upside risks to that call?
Right now it's 5250. The upside risk is we get softer employment data, so bad macro data, actually, or soft macro data, let's say, and brings down yields, takes the heat off the inflation focus, gives the Fed the door to open to cut rates, maybe once or twice this year. That's, to me, upside. We're living in a very bond-driven equity market today.
And so is your base case that we are not going to get cuts, in fact, this year, or that maybe we're not going to get very many?
Base case is that we will see enough softness, even in data like NFP, non-farm payrolls, and an uptick in unemployment claims starting in the coming months and really start to show up by the back half of the year, which will open the door to get those cuts. So we've seen a huge shift year to date in Fed expectations in 4.5, 5 months. I think we could see another decent shift over the rest of the year.
And Michael, where does kind of the opportunity look to you right now? What are you kind of screening for, and maybe some examples of that?
Sure. We've been big bulls on quality stocks, which have essentially become what it's being talked about now as the momentum trade.
And when you say quality, Michael, how do you define that?
Yeah, companies with higher levels of profitability, companies with higher free cash flow yields, so they're not all expensive. And we look at it cross sectors, so it's never about 7 stocks or one sector. This is a theme you really see across sectors, and particularly as you go down in capitalization. So as you look for smaller caps that have really underperformed for a couple of years now, there's a huge bifurcation in performance of the haves that have earnings growth, earnings revisions, and have good profitability, and those companies that are clearly struggling from the high interest rate and sticky inflation backdrop.
Yeah, I think we have some low cash yield examples in the last 12 hours, companies that have reported that have been struggling on that front.
Absolutely.
And so do you think, in terms of the top picks, and we just showed some of them that maybe would be considered quality, the TSMCs of the world, there we go again, Abbott, AbbVie, et cetera, that are they sort of agnostic as to where yields go because of that cash position? Is it sort of a buffer, if you will?
Yeah, they're insulated.
Right, that's
from
the word
yields.
I'm looking for.
If we look at the beginning of the year, the first quarter, large cap growth stocks were up 12, 13% by the end of the first quarter. Small caps, all the way to the other end of the spectrum, were flat. And this year we've seen, obviously, yields go up. They got to a point where now all equities have kind of struggled. But for the first 3 months, it wasn't an issue for these higher quality stocks that are insulated, which also means if we do get any soft macro data and lower yields. The ones that are more insulated are less likely to respond as positive compared to the regional banks, small caps, and deep value stocks.
Sell in May and go away, Michael. How much weight as a strategist do you put on seasonality?
You know, when there's not a million other macro data points and an election and a key Fed meeting to kick off May, I'd say it's maybe a little more relevant. Seasonality, I think, is something that's interesting, but can often be overwhelmed when there's other market moving events. And we have so much data now between geopolitical issues, the politics, fiscal, the QRA is coming up, and a Fed meeting. So to me, those are going to take precedent, as well as CPI and other data. So generally, and when the economy is accelerating, getting better, and particularly when investors are not worried about inflation, stocks do great between May and the end of September, and vice versa. So to me, it's interesting, but there's so many other overwhelming factors that can play.
Michael, it's interesting, just tonally, you don't sound super bullish to me. I mean, yes, your target is above where it is right now, but you're not like pounding the table and saying the market is going to do great from here, is the vibe I'm getting from you. Is that fair to say?
Yeah, because the best years for equities are when you get large PE expansion. It's actually not when earnings are taking off. That tends to be late cycle, and we tend to be worried about inflation and maybe the Fed starting to hike. So it's hard. That was last year where where valuations really expanded. This year it's going to be hard, and we've already seen some PE expansion, but it's going to be hard to really make that much bigger move. Again, I think the catalyst, especially for those laggards, would be lower interest rates. Mm-hmm. But yeah, I'm at 52.50. I think we've had a great year last year, coming off a terrible 2022, and there's a lot of soft landing hope priced in. There were a lot of rate cuts priced in, and the market is so data dependent right now. I think it's really about stock picking as opposed to where the index is going to make a major move.
Gotcha, Michael. Thanks for coming in.
Yeah,
Good to see you in person.
Thanks.
Appreciate it. Well, we're just getting started here on market domination. Coming up, Boeing shares lower today despite topping earnings expectations. We'll talk about those numbers with an analyst on the other side. Plus, another round of earnings on tap after the close. We'll get you all those results from Meta, Ford, IBM, and Chipotle once those cross. Plus, the latest edition of our series, Goodbye or Goodbye. We'll get insight on 2 stocks to help you make the best choices for your portfolio. Stay tuned. We've got more market domination after this. Boeing blew through $3.9 billion in cash in the first quarter, but it was better than the $4.4 billion that analysts estimated. Questions still circle around the embattled airplane manufacturer, including production quality, the search for a new CEO. Here to help us break it all down is Robert Spingarn, Managing Director of Aerospace Defense and Space at Melius Research. Thanks for being here, Robert. So when we look, it's interesting because initially there was a bit more of a positive reaction when it came to Boeing, maybe a little bit of relief. Then we saw that fade. What do you think sort of took over here? Just that the road is still going to be tough for Boeing?
Yeah, that's really all it is. I think people were long into the quarter expecting some positive news. The CEO gave a pretty positive, upbeat interview on television this morning before the earnings call. And then you get into the details in the earnings call and you see it's perhaps a little bit more complex a recovery story than it looked earlier in the day.
And Rob, it sounds like they're standing by their free cash flow target, $10 billion by 2026. Did that surprise you, Rob? They're going to stick by that bogey?
Yeah, a little bit. I mean, we reduced our number roughly a month ago. Think that that's a bit of a stretch to get to that $10 billion in 2026. The CEO said he thinks they can do it. The CFO, interestingly, suggested, at least to me, that maybe they hit that run rate toward the end of the year in 26, so maybe a little bit later. But they got to chop a lot of wood to get there.
Talk us through some of that chopping, right? I mean, we know a lot of the challenges that are in front of Boeing right now. What do you think is sort of most urgent and important for the company to accomplish this year, besides, finding a new guy to run the thing, or woman?
Well, so there is that. But the two most important things are the 737 and 787 production rates. Those are the two cash cows in the commercial airplane business, and they need to stabilize those aircraft programs and raise those rates to generate cash. So again, the two cash cows. Then they have to improve the defense business. And that did come in a little better than expected today. So that was one of the positives. But it's still a negative cash flow business, and it's got to swing to positive by 2026 in order to hit that $10 billion number.
And Rob, I don't think I've had the chance to get your take on the Spirit acquisition either. In your opinion, smart move, Rob, positive for the business?
I think it's kind of inconsequential. We've taken the view that Boeing has wielded a lot of influence at Spirit since the spin nearly 20 years ago. They've had people in those factories for a couple of decades. They can ask Spirit to do the things they need them to do. So I don't think it's necessary that they have to own Spirit in order to get it to improve better. Yes, they can put them on common systems and so on, but there are they have plenty of access to Spirit the whole time. What really needs to happen is both Spirit and Boeing have to improve their operations, and they can do that separately or together.
What does the regulatory landscape look like right now for Boeing? What's still to come in terms of, consequences or new regulations put on the company?
Well, that's a little bit of an unknown. They're still under scrutiny for the tragic accidents that happened a few years back, and that is now being revisited. Some of the families are asking the government to reopen investigations, and we don't know how that will play out. We don't know if this incident with Alaska Air 1282 allows for the reopening of the deferred prosecution agreement from a few years ago. And then the other side of this is the FAA is simply going to mandate a certain level of increased scrutiny and oversight over Boeing's operations. And going forward, I'd like to think that scrutiny oversight will be consistent. It makes the environment, the industry safer for everybody. Boeing will adapt to it, so will the other aerospace companies, and that's a good thing.
And Rob, in terms of just kind of events coming up on the calendar, you do have that Farnborough Air Show, Rob, coming up. I think it's July. Is that important for Boeing at all?
Historically, the air shows, Farnborough in July and then alternating with Paris in June the next year, have been a great place for orders to materialize and for industry to get together. It's really about orders. That's been less important, I'd say, over the last decade. Having said that, though, because COVID canceled a couple of those shows, the last Paris Air Show was a big deal. Farnborough could be a big deal for orders this year, but I would say that that's more of a side event. Where the focus is going, the scrutiny is going to be at this point, where Boeing is concerned, is on getting those aircraft production rates stabilized and then raising them.
And so, Rob, maybe you're leading to my last question for you. You have a hold on the name, so you're on the sidelines. I was just going to ask you, Rob, what kind of you're looking for? What would it take to get you more bullish on Boeing?
Well, exactly that. I want to see evidence they've really got their arms around these production rates and that they can raise them sustainably. There's been a lot of volatility month to month, quarter to quarter. We need to see these rates stabilized on an annual basis and the ability to move those up over the next couple of years toward those targets. And once we see that, we can get constructive. At the same time, we need to see improvement in the defense business, debt retired. And the other thing, I haven't mentioned it yet, we really do think the company needs to think about its next airplane. It is losing ground to Airbus. The longer that they wait to start a new aircraft, and that does preserve cash flow, but there's two sides to this coin. The longer that they wait to start on a new airplane, the more ground they potentially lose later on in the next decade.
Interesting. And they've obviously, to your point before, they've got a lot to do before they can get to that new plane. Rob, thank you so much. Appreciate it.
Pleasure.
Let's take a look at some of the other top trending tickers right now. Well, Tesla, of course, is soaring today. The news of the EV maker's robo-taxi plans has both Uber and Lyft taking hits today. Tesla still up by about 12%, Uber down 2.5%, Lyft down about 3% here. And what's interesting is, of course, is that the robo-taxi remains as of, and Musk also talked about a ride-hailing app that Tesla's developing. What's interesting about all of this is it as yet remains mythical, right? Like August 8th is this event. We don't know. Most experts in autonomy will say it's still, that doesn't mean it's rolling out this year or next year. We still don't know the details of that. So even if there is some sort of competitive threat to Uber and Lyft, it is not, doesn't seem to be an imminent one.
Yeah, it was so interesting, Julie, because it was sort of like one company with almost two calls, because it was like, the core business is not good. I mean, you missed on the top and the bottom. So to your point, Musk kind of addresses that, but then shifts. And in part, he was kind of laying out his vision for the company. And I listen, we have had investors in Tesla. It's part of their thesis, right? Long term, this is autonomy, and this is what Musk is saying. If somebody doesn't believe Tesla is going to solve autonomy, I think they should not be an investor in the company. So laying down the gauntlet, he has this vision. To your point, I mean, what is the actual timeline here when it's actually in service? I don't know. I mean, is it 5 years? Is it 10 years? NBC News reported the company actually hasn't even sought permits that would let it test and operate robotaxis in 3 states, including California, Nevada, where obviously it has a lot of employees. But he has a vision, and certainly if you're a bull, there's plenty of people who are in Tesla for this reason. They take that long-term view. Right,
and there's also this sort of, again, tentative idea of, you sort of rent out your Tesla when you're not using it.
Like an Airbnb, Musk said.
Like an Airbnb for cars. Again, that may be seen as a threat to Uber and Lyft. I don't know how many people are going to want to do that. Yeah. But again, there's not a timeline, but timelines, it's not really Elon's thing, timelines. He doesn't. But listen, talking is confident as ever. No matter what, even if I got kidnapped by aliens tomorrow, he says, Tesla will solve autonomy. Maybe a little slower, but it would solve autonomy for vehicles at least. Aliens, are you listening?
Yeah. All right, checking in, moving on. Shares of Norfolk Southern lower today after missing on earnings estimates. The rail operator is saying it's seeing some pressure following the collapse of the Francis Scott Key Bridge in Baltimore last month. According to CFO Mark George, the revenue impact from the channel closure is in the $25 million to $35 million per month range. So this was interesting, Julie. So that was Norfolk Southern's call. Q1 adjusted earnings and revenue. Sounds like they did just kind of slightly undershoot what the street was looking for. And it did talk about this kind of pressure following the collapse of the bridge. The revenue impact, $25 to $35 million per month. Execs saying they're working on it, trying to provide alternative supply chain solutions, but this clearly, a challenge.
Yeah, and the company did see that volume grew by 4%, but revenue fell by 4% because there was the lower fuel surcharge, and they also had a worse mix, I guess, on the platform compared with last year. Something that's going on in the background here is that the company is undergoing a proxy battle. So some analysts said this earnings report, people are sort of looking past it to this proxy battle that's going on with an investor called Ancora Holdings, which is calling for changes at a Norfolk Southern, including, they say there's been poor decision making and that the stock has underperformed. And so that's going to be the next thing that investors are going to be looking to.
Yeah, we should note, by the way, Norfolk isn't alone in terms of the impact from the bridge in Baltimore. Rival CSX said last week it could lose between 25 and 30 million in sales a month due to that port closure.
And then quick mention, Old Dominion Freight Line also reported, but that's not a railroad. It's
getting knocked around.
Trucking company getting knocked around because that company's numbers missed analyst estimates. Yeah. And it's in the less than truckload business, which has been doing better than the rest of the freight industry apparently this year. So the fact that they missed a little bit, that's why it's getting punished.
And it's interesting, Joey, because I think if you're an investor, these are the companies you watch because these are the companies actually moving stuff around the country.
Good point.
And as an investor, you like to watch that kind of like it gives you that temperature check on the overall economy. So you don't like to see those kind of hiccups.
No, you don't.
Coming up, it's latest edition of our series, Goodbye or Goodbye. We'll get investor insight on 2 assets to help you make the best choices for your portfolio. Stay tuned, more market domination after this.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're taking a look at names in materials and energy, which are worth adding to your portfolio and which are best left behind. I'm here with Jacob Sonnenschein, markets reporter at Barron's. Jacob, come on down. Let's talk about what your buy stock is. First of all, Air Products and Chemicals. So this is an interesting one. It's not a name that we talk about an enormous amount. The stock is down this year, so let's get to your case here. and the stock being down is part of it, because you say a recovery is coming.
I like quality companies that are down double digits. It is a little bit cyclical because of the end markets that it's exposed to in industrial gases, selling to a lot of manufacturers, consumer end market stuff like that. So it's gotten crushed. China, which is a big part of the business, has been a problem. Roughly $3 billion of sales in the last reported quarter. As you move out a few quarters this year, every quarter, and new projects come online and they're not delayed, and China continues to grow, analysts are looking for Asia growth for revenue for APD of just under 2%. If you think about the way China's growing, it's actually pretty reasonable. New projects coming online, those quarterly revenue figures should come in better. There is a bit of a long-term thesis, which I'm sure we'll get to, but in the near term, I think the earnings estimates have reset lower, the stock has reset lower, and it's a decent buy here.
Okay, let's talk about the next point here, which is that they have fixed contracts for their industrial gases.
Yeah, exactly. And so they are cyclical because of their end markets, but with those fixed contracts, it does make that cyclicality, that sensitivity to the economy a little bit less so. There's a certain price range and volume count of just like amount of chemicals in those contracts that they can sell. So investors know that there's that buffer on the downside with revenue and earnings because of those contracts, right? So that's not a terrible situation.
Okay, and then the third thing is sort of like the new zeitgeist in gases, if there is such a thing, and that's clean hydrogen. And so what is Air Products doing in that space?
Clean hydrogen, the total market for that substance today is $0. What they're doing in that space is they're ramping up. There are 3 big chemical makers in the world. It's Air Liquide in Europe, it's Linde, which is a peer to Air Products, and it's Air Products. If you are a larger, fairly well-scaled chemical maker, Air Products has a market cap of about $50 billion, you can invest in clean hydrogen. That market could be, when I look at the number of tons that could be purchased, price per ton, it could be hundreds of billions globally over the next 5, 6, 8 years. I don't know that Air Products gets so much of that, but they're doing less than $15 billion annual sales. That's a huge opportunity, and it makes me bullish on the long term. Okay, well, we always like talking about the risks, and the risk is actually around clean hydrogen. You talk about the risks from delays. I mean, it's also just sort of a risky, unknown where that market is going to go as well. So when you talk to analysts about a fairly cyclical company like Air Products, and they say, well, the risk is project delays. Okay, that's analyst jargon for that industry. What that really means is that if customers are delaying purchasing things from or new projects to come online, new contracts, those delays, that to me, I hear the word cyclicality. I hear that industrial companies around the world are pulling back on their spend because their end markets are a little bit slow because you have higher rates that do continue to flow through the global economy. Gotcha. All right, well, let's get to the other stock that you don't like here, and that one is in big oil. We're talking about ConocoPhillips. The shares are up a little bit year to date here, but let's get to why you don't like it. Oil prices. Now, this is a little counterintuitive to me, oil prices, because oil prices are up. Why is this a risk for ConocoPhillips? And it's funny because a few months ago I had written you probably want to buy oil because it looked from a technical standpoint where like oil prices were going up. So it happened. So oil prices go way up. U.S. oil producers go way up. ConocoPhillips, since that there's like a little bottom somewhere with oil and the stocks in January, ConocoPhillips has looked like this chart, and so it's up about 22%. And it's baking in higher oil price, a lot of leverage to the bottom line for earnings because they have a lot of fixed costs and higher earnings estimates. Those earnings estimates for oil will probably come in. The reason I don't like ConocoPhillips is because Chevron and Exxon have talked more about transitioning to responsible, clean oil production. ConocoPhillips has talked about it, to be fair, but not a lot. And in their 10K, they talk about risks, not opportunities. They talk about risk when it comes to clean energy. So they've had this big rally already, and they're not up there, in my opinion, with Chevron and Exxon with the future. Okay, and as you point out, the clean energy projects take time. So I guess what you're saying is if they're not already doing, if they're just talking, then they're going to be behind their competitors? Oh, the whole thing's going to take time, and there are not a lot of numbers around cleaner, zero carbon emission. Like BP talked about it by getting to net zero by 2050. And if you just read up around, I think you want to get away from analyst land because so much of this is unquantified today. There's an article from The Guardian saying, hey, this is going to take some time addressing the entire space.
Right, exactly. Okay, so let's also talk about what's happening with trades here, insider trades. Sales, I assume, if you're looking for a negative signal that we've had some insider selling going on.
Yeah, you're talking about ConocoPhillips?
Yes.
Yeah, that's never a great sign. That's not a huge focal point for me when I look at a company, but I probably will be in the future. But I mean, that's never a great sign.
Yeah, all right. So the risk that it could make it do better here is that you do have oil going to triple digits or beyond, I guess.
So oil's gone up to a little above 80. I'm thinking of WTI. Brent crude's a little bit higher than that. And then it stops, right? It had this little spike when the Israel-Iran issue happened, and then it came back down. So it's like, okay, if that issue can't cause more upside, what you would need more upside for the price of oil is a reflaring or a worsening of the situation, unfortunately, overseas. If you get that, yes, you get a pop in oil and you'd want to own ConocoPhillips, but I never would tell somebody, hey, own a stock because this event might happen and I have no idea.
Right. All right, so let's sum up what you've said. And by the way, as a Barron's reporter, you don't own any of these or have a position in any of these individual stocks. But let's sum up what you're telling people. You would recommend buying Air Products and Chemicals based on an achievable recovery, limited downside risk, and the big potential in clean hydrogen. On the other side, you say avoid ConocoPhillips for limited growth in oil prices, a longer timeline in clean energy initiatives, and insider selling. Thanks so much for being here, Jake.
Thank you.
Good to see you. And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern.
Time now for the day's trending tickers as we approach the closing bell on Wall Street. B. Riley shares, check them out. They are surging as the company delivered its annual report after delays amid its internal investigation. So the news here is just that. The bank finally files its 10-K. It had been delayed. Now, the filing did flag, per reports, Julie, material weaknesses in its reporting. But I think the bank is saying here, and this is a key, that this independent investigation effectively reached the same conclusion as a previous review did, that it had no involvement with or knowledge of alleged misconduct concerning this client named Brian Kahn. And the questions had been raised about his role in a hedge fund collapse. Shorts had kind of flagged that relationship. The stock got whacked, but now bottom line looks like a giant sign of relief from investors.
Right, and Kahn himself hasn't been charged with anything,
Correct.
and he denies wrongdoing. But regardless, this does seem to put some space between B. Riley and whatever allegations are against him related to the collapse of a hedge fund. And so, as you said, a lot of relief being expressed here. The shares were up even more out of the gate when the company came out with this report. So there still are perhaps some critics out there who are going to find what they want to read into the report. But for the moment, shares up 37%. So recouping some of the recent losses. Let's also talk about solar. And Enphase Energy shares are sliding after that company missed estimates on the top and bottom line. Second quarter revenue guidance disappointing. We also got some news from SunPower, which you see there. The company is going to be cutting jobs. But let's talk Enphase first here. It makes solar equipment. And what's interesting is the company says things are bottoming. It actually says the second quarter is kind of the worst that things are going to get here, that the U.S. rooftop solar market is going to rebound. But investors perhaps are not so sure and are looking at the numbers that were just reported.
Yeah, to your point, the execs are saying, Julie, Q1 was the bottom quarter. They say the second half of the year we expect stronger growth in demand. Team at KeyBank, though, saying here lower than expected Q1 results and issued guidance continue to weigh on the story, deepening the road to recovery. And of course, Enphase really kind of seen as a bellwether for the industry. So you did see some follow through, other names reacting.
Yeah, one big event that affected the industry this year is California pays prices to consumers who sell energy back to the grid. They cut those prices, and that was a sort of a shock to the system, the whole ecosystem within solar, but that's now being lapped. So that's one of the reasons why the company says things are going to get better. But over at SunPower, which does the installations of those rooftop solar projects, it's cutting more than 25% of its workforce. It's going to close residential installation locations, and it's sort of pivoting its model here. Just another example. High interest rates have been tough for the solar industry, so that's part of what's going on here.
And these stocks have been just whacked.
Yes.
I mean, Enphase is down about 50% now over the past 12 months. Moving on, Trump Media CEO Devin Nunes doubling down on his claim of the DJT stock being an apparent victim of naked short selling. Here with the very latest is Yahoo Finance's Alexandra Canal. Allie.
Hi, guys. Yes, so this is a letter that Nunes sent to Republican lawmakers, essentially accusing potential manipulation of the stock price, saying that there's been anomalous trading of shares. He says that there's been unlawful trading activity, which does stem from the naked short selling. Now, in order to understand this, if you want to go and short a stock, a trader must first borrow shares that are already owned before they can be sold. And a naked short sale is an illegal practice of selling a short share that has not yet been borrowed. So this is the crux of the issue here. We do know that short interest in DJT stock that has only increased as the company has hit the public markets. Short interest is about 13% of outstanding shares. That's according to the latest data from S3 Partners. The company has attempted to fend off some of those short sellers by giving investors some advice, tips, and tricks on how to avoid their positions from being shorted. Now, I do want to point out that Nunes has singled out 4 market participants that have been responsible for more than 60% of the volume of DJT shares traded. That includes Citadel Capital and Jane Street Capital, Citadel Securities, I should say. And this is something that Nunes echoed in a previous letter that he sent to the Nasdaq on April 18th. And following those accusations, we did see Citadel come out with quite a fiery response, saying in part, quote, Devin Nunes is a proverbial loser who tries to blame naked short selling for his falling stock price. We have seen shares of this company trade very volatile. It is down about 50% since that public market debut, but at current trading levels, it does boast a market cap of about $4.9 billion. That means Donald Trump has a stake of around $2.9 billion, and the stock did hit a key milestone yesterday close, which means that Trump secured an additional $1.2 billion. So he can't trade in for 6 months. So that's something to point out. We'll see over the next 6 months if we can continue to see these levels. I'm going to continue to watch moving forward.
Yes, thanks for watching for us. Appreciate it, Allie. Well, hot off the heels of Tesla's results, we're taking a broader look at how investors should look at the auto sector and how they should trade it. That's next in the Playbook. Ford is the latest automaker scheduled to release its first quarter earnings results after the bell. And amid the ongoing EV push, car makers continue to focus on both fully electric and hybrid options. But affordability and access do remain a top priority for customers. We're looking at how to navigate the big picture with the Yahoo Finance Playbook. Joining us now, Olivier Blanchard, Research Director for Semiconductors, EV, and Autos at the Futurum Group. Apologies, I speak French, so always wants to be the French pronunciation. Olivier, we've got Ford coming after the close. We already heard from General Motors. We already heard from Tesla. If you're an investor, how are you sort of weighting these as we sort of go over these earnings?
Right. Well, it's the EV space is a complicated space, and I would say that the automotive space more broadly is a complicated space as well. And the way that I like to look at this is it's not just about EVs, it's also about software-defined vehicles. And sometimes we conflate EVs and software-defined vehicles because they tend to merge. But there are essentially two technology tracks there. One of them is obviously the decarbonization and the battery versus hybrids versus fossil fuel part of the equation. And the other part is all of the technology that goes into vehicles, like ADAS, like cockpit technologies, like all the connectivity stuff and the intelligence that will eventually take us to these computers on wheels that can do anything for us. And so when I'm looking at which companies have a long runway of success, I don't want to be bullish about Tesla, but because obviously they have some operational issues. But all of these companies, whether it's Ford, GM, BMW, the Chinese manufacturers, Tesla included, are all on the right track for growth. And so I think that some of the pains that we're seeing now are growing pains. They're also reflective of seasonal behaviors, people buying cars at different times of the year. And I think they also reflect a little bit the state of the economy. Currently, the EV market and the automotive market for software-defined vehicles and EVs simultaneously is a little bit skewed on the side of more expensive models. And consumers are just kind of worried about that kind of spending right now. Things are very expensive. Obviously, there's inflation. There's a little bit of price gouging, and people are a little bit closer to their budgets. And so what we're seeing is a reluctance to buy EVs for two reasons. One, most of them are still a little bit above the price point that the average consumer for a mainstream adoption of EVs is comfortable with. And the other one is fear about charging and infrastructure, about the serviceability of the vehicles, and also about the long-term resale value of these vehicles once the batteries and the technologies that are on board have a few years on them.
Olivia, so if price is an issue, though, Elon Musk just told you help is on the way. He's got a more affordable version coming. I guess I have two questions, Olivier. One is this more affordable version. I'd love your guess as to what that is going to be, Olivier. Is it going to be a truly new vehicle or just kind of, an existing vehicle with some tweaks? And two, what do you just ultimately think demand's going to be like?
Yeah, so I think you have to look at the price points that consumers are comfortable with. So let's say the $35,000 range for a new vehicle. Obviously, that's going to be much more stripped down than a luxury vehicle that's $75,000 or $100,000. And so I think that those parameters and those breaks within the industry with the price points are pretty much set already. Now it's up to the OEMs to come and meet those price points with the types of features and performance that match them. Unfortunately for Tesla, I don't know what it looks like yet, and I don't think that Tesla knows what it looks like either. Obviously, they've slashed prices last year to great effect, right? They had a banner Q4 in Europe and in the US. But unfortunately, it's kind of a silver bullet that you can only fire every once in a while. And so now you're seeing Tesla basically just having purchased a lot of this volume with profitability, and there's not a lot of room for Tesla specifically to go from a positive profit standpoint in terms of cutting costs. So I don't know if there's a short-term solution for Tesla there. However, for companies like Ford, GM, a lot of the Korean companies, the European companies, and obviously the Chinese EV OEMs, that's something that they're a little bit better at, and that they're I think more experienced working with, and also they have more scale production-wise.
And Olivia, when you're looking at ways to sort of play demand for autos, I know that you're also looking at the broader tech ecosystem when it comes to chip makers that service the automakers, for example. Are those companies, can they do well even if, for example, EV sales aren't as strong?
Yeah. So I look at a company like Qualcomm, for example, that has this sort of like full digital chassis platform that's kind of layered. So you can purchase the entire stack from them and try to do kind of like a Qualcomm flavored Tesla stack. Or you can pick and choose. And I think that's where so there are essentially two tiers here. There's one from the technology side where you can go to the luxury performance all the way down to sort of like the budget performance and just enable the right features for the vehicles and choose the systems on chip and the essentially the hardware that's going to be most adaptable cost-wise to those lower cost vehicles, or go with the premium and equip your vehicles that way. And the other thing is just limiting the number of features. So you could have an EV that has very few digital features on board, right? So you might have like just an L1 or maybe a low L2 level of driver assistance, as opposed to the L2++ or L3+ that you might see in more advanced vehicles. And that's just a way to kind of pick and choose which features match the specific price points that are going to appeal to those consumers. Yeah. So there's in other words, there's a lot of flexibility there for the OEMs to work with their technology partners to find the right mix.
Makes sense. Olivier, thank you so much for joining us today. Appreciate your time.
Thank you.
Coming up, it's the closing bell on Wall Street, and that just means it's about time to break down some earnings reports, the latest from Meta, Ford, IBM, and Chipotle, and much more when market domination overtime begins.
There's the closing bell on Wall Street, and now it's market domination overtime. We're joined by Jared Blickery to help get you up to speed on the action from today's session. Let's start with where the major averages ended up, sponsored by Tasty Trade. We've got the Dow very slightly changed here, just down about 43 points. So kind of come into the unch line for all three major averages. In fact, the S&P also little changed. The Nasdaq up just about 0.1%. As we talked about earlier, really today, it is individual stocks that are pushing things around rather than a big macro narrative. This is even with the 10-year note at 4.65%. up about 5 basis points, but not really putting that much pressure on big tech as we await some big earnings. But Jared's got a closer look at today's sector action and more. Hey, Jared.
Hey, Julie. Well, let's take a look behind me at the Wi-Fi Interactive. You're going to see consumer discretionary in the upper left. Guess what the biggest component in that is? It's Amazon. But number 2 is Tesla, and Tesla is flying today. So consumer discretionary really powering things higher. But number 2 is XLP. That's consumer staples. Then you have utilities, and then you have tech, which is XLK, real estate and communication services. Really odd mixture of growth and a little value, and also defensive stocks in there as well. Now, to the downside, we had industrials down 0.8%. That is a Boeing story, another earnings story. Healthcare also down 1/3%, and financials just barely negative. Want to show you the Nasdaq 100 here before I go. NVIDIA is a standout. That was down about 3.33%. A nice number there. And then Tesla up 12%, best day in over a year. I get those final stats, but it really is a story of individual stocks here, as you said, Julie. Back to you, Josh.
Jared, thank you. Stocks ending the day little change, climbing from the lows as investors weighed rising interest rates and earnings. Alexander Canal and Josh Schaefer are here with the takeaways of the trading day. Guys, over to you.
Yeah, Josh, I mean, I think to me, the biggest takeaway was that maybe there wasn't a broad market takeaway today, right? I think sometimes we don't have to make something out of nothing here. When you look at the 3 major averages, we really didn't have a big move. I mean, the one thing that really sticks out, obviously, is that over 10% jump you saw in Tesla, that, of course, driving the consumer discretionary sector higher and sort of leading things. But, Ali, what stuck out to me about that move was there's been plenty of days where we've talked about Tesla after earnings and that driving action in the Nasdaq, that driving action in the broader market. And that wasn't really what happened today.
Yeah.
And maybe that has something to do with these higher bond yields we've been talking about a lot. Julie mentioned we didn't get a big jump in the 10-year today, but we certainly didn't have yields down. And it seems like with yields at this level, maybe investors are just being a little bit more cautious and sort of waiting to hear from these companies in earnings.
Yeah, especially with a lot of the big tech heavy names coming out tonight and over the course of the week. I mean, even so, the fact that we're nearing that 4.7% on the 10-year, that's the next technical level that strategists have said to watch. I think that's something that's significant, and we've seen that hammer small caps. We've seen that hammer mid-cap companies. These larger cap names have been pretty insulated from this due to AI to a certain extent. How long can that be the narrative that plays out? And, you know, with Tesla, I think it's interesting too, because we saw them miss on earnings and revenue, and it shows that it's not just about the current story, it's the future, right? And I think that's what investors were trading on with Tesla, the future of this company.
Well, it shows the faith-based trade is not dead.
Right. And I think that goes to a point that you were bringing up, Josh, how it's not just about a beat and hold sort of season, this earnings season. It's more about the raise, the guidance raise, and we've seen that play out with names like Netflix, for example. You had that company come out, pretty solid earnings overall, but the stock went down, and partly the reason why was because we didn't see that guidance raise. We saw actually guidance come in below estimates for the second quarter and the full year, and that creates some jittery feelings among those investors.
Yeah, Drew Pettit from Citi was on this morning on the morning brief show talking about that, sort of the environment right now, given the rally we've seen a lot of these stocks, and one stock that we're waiting for right now in Meta, right, and sort of that massive rally you've had over the last year. Beat and hold, so beating estimates but holding on guidance, just really hasn't moved the bar. I think back to JP Morgan, right? JP Morgan had largely, I think people would argue, pretty good results. And really one of the things investors were caught up on was the fact that they didn't raise their guidance to the expectations that people hope for. And I think you get to this point in the market rally, especially with a name like Meta, with a name like Microsoft or Alphabet coming up tomorrow, that it's just how much is already priced into that stock, and a significant amount of growth is already expected from these companies. And it sort of gets hard to meet that after a while, which I think is why a lot of strategists are sort of looking for a broadening out, right? Because if you're looking at other sectors, those sectors might have a chance to actually beat expectations. Versus these massive companies that have high expectations, it becomes a little bit harder.
Yeah, and we were just looking at a Meta chart over around 40% year-to-date gains there, and over 100% over the last 12 months. So you talk about elevated expectations heading into the print. Tesla was the exact opposite. Tesla has really been struggling over the past year. So I'm curious to see the move in Meta. Obviously, that has been boosted by a number of their initiatives, but also the fact that we saw a dividend, we saw stock buyback. That obviously a good thing to help boost shares.
Well, and just thinking about sort of the macro drivers too, as we were talking about today, we had a day where Tesla rises over 10% and the market doesn't really take off on that, right? The Nasdaq doesn't take off. We don't see a big move. It'll be interesting to watch the market action over these next couple days of tech earnings as we see sort of investors digesting these earnings. Is that the big driver right now? Is maybe a GDP print tomorrow that can move yields, as we were talking about, going to be one of the bigger drivers? I think that's something that people are focused on right now, is sort of what are we going to pick out from these different results to sort of get some sort of maybe a more solid narrative, because I don't really know if we have one thus far.
I think it's going to be Meta. And let's talk about Meta.
What'd they say, Julie?
Okay, so they came out, it looks like the first quarter came out comfortably above estimates. The second quarter, though, maybe not as much. So the first quarter revenue at $36.46 billion is indeed above what analysts had been anticipating. Earnings per share as well, $4.71 versus the $4.30 that analysts had been anticipating. But if you look at the second quarter revenue forecast, 36.5 to 39 billion. The midpoint of that looks to be below the about $38.25 billion that analysts had been anticipating. So the quick reaction here is that the shares have fallen. But to your point, Josh, Schaefer, that is, this is a stock that's up 39% year to date. And so how much is priced in already is a great question. I'm just looking at the statement here. Mark Zuckerberg says it's been a good start to the year. He's pointing out the new version of Meta AI with Llama 3, he says, another step toward building the world's leading AI. We're seeing healthy growth across our apps, he says, and we continue making steady progress building the metaverse as well. So it doesn't seem like anything fundamentally is changing with the strategy at Meta. At first glance here, it seems to be folks are focusing on that second quarter forecast. I'm going to keep digging in here.
Yeah, I mean, the stock, listen, as we were discussing, heading into this print, it had been a monster. It was up about 40% this year, and now you're giving some of that back in the after hours. And it does look to be that Q2 sales forecast lagging at the midpoint there, Julie. It's also, I'm just looking at expenses, because that's another big, obviously, focus for investors with this name. They see full year total expenses now 96 to 99 billion. They had seen 94 to 99 billion. A lot of questions on that call about the guidance. What are they seeing that maybe the street missed? Other issues that are going to for sure come up, companies' AI tools, Reels monetization. President Biden just signed into law, obviously forcing a sale or a ban of TikTok. I think there's a lot of questions about what that could mean for Meta. How much could that benefit if that really goes through?
Yeah, so let's talk about some of the stuff that is contributing to those higher expenses, because to your point, the street loved it when they were cutting expenses. Yeah. So what's the reaction going to be now that they're increasing the lower end of the expenses there? So the company's talking about higher infrastructure costs, higher legal costs, which is something that we know has been sort of ramped up regarding the company. And for Reality Labs, operating losses will increase meaningfully, that's the word in the statement here, meaningfully year over year due to our ongoing product development efforts and our investments to further scale our ecosystem. Capital expenditures this year are going to be $35 to $40 billion. That had been to 30 to 37, so they're increasing that range. Well, I guess they're lowering. Yes, they're increasing that, they're increasing that full range as they are accelerating infrastructure investments to support artificial intelligence. So again, the street loved it when these guys were seeing the light on expense reduction. Now, Mark says, maybe let's just let it creep up a little bit here.
It'll be interesting to see sort of how he talks around that on the call, right? Because there is certainly in a part of the AI investor story that I think investors largely understand at this point, which is expenses are going to go up. If you're investing significantly in AI, it is going to cost a significant amount of money. These companies, Meta, including also Alphabet and Microsoft, are expected to be increasing CapEx over the next year and be the main CapEx drivers in the S&P 500. So I don't think it's necessarily a shock. Of course, they're raising their expectations for how much they're spending than a little bit more than before. But to me, it will be interesting to see sort of in the next day or so how we digest exactly how they're spending that money and what it's going to do, because when it gets in that Reality Labs segment too, I think that's maybe where investors might get a little hesitant. Right. That has not been the most productive part of Meta's business since they launched that part of the business. And so I think maybe understanding where they want to spend that money, how it probably leads to some sort of AI solution that's going to help the company might help a little bit.
Yeah, and I think this is going to be something that all of these big tech names, especially those with exposure to AI, are going to be dealing with. And it's interesting to see the after-hours reaction to some of those Meta competitors. You're seeing Alphabet shares down about 2% right now in after hours. Microsoft not as bad, about half of a percentage point right now. But again, that's something that I think investors are going to be really focused on, just the spending and again, guidance, like what we were talking about, that miss really driving shares lower.
My big question, is he going to be wearing the chain?
I know.
On the earnings call.
Shares will rise.
Shares will rise.
That is how you drive a stock
The
higher.
reception to that, it was like
It's
the
over.
biggest makeover ever. All right, thanks guys, appreciate it. And joining us now to dive deeper into Meta's results is Rohit Kulkarni, Managing Director at Roth MKM. Great to see you as always, Rohit. So what is your sort of first blush reaction here, especially given that we're seeing this tumble in the shares?
Again, we thought the expectations were high going into the print. Street estimates, they beat street estimates for 1Q. That's a good sign. Probably they came in line with what investors were expecting. The key kind of yellow flag here is the high end of guide does not bracket what investors were expecting. Investors, in my opinion, were looking for close to $40 billion, maybe slightly more than 39.5. So I think Q2 guide is one yellow flag. And as you guys mentioned, the CapEx and OpEx both are rising. So second quarter in a row, they're raising CapEx guide. So clearly, how much they're investing in AI for infrastructure is going to keep on ramping up. And they have this curious little quote inside the PR saying, we are not giving guidance for 24, but we think we'll continue to invest in CapEx and AI infrastructure. So which means CapEx is going to continue to rise and probably they keep playing catch up. So those are the three worry points. Q2 revenue guide, 24 OpEx rising, 24 CapEx rising, second time in a row. In isolation, again, for Meta, the valuation support that you get around $440, $450 per share is extremely solid. It's trading at around 18 times right now for next year's earnings. I think you don't get an asset like this. So it continues to bounce between where it is right now to maybe back to 500 over the next few months. So we would be buyers on this weakness, but we'll love to understand what's going on with the CapEx guide.
And Rita, I'm also just curious, you'd be buying on this weakness, but in the quarters ahead, do the comps actually get meaningfully tougher, Rohit, from here?
Yep. I think comps get tougher, and the second double whammy, Josh, they have is investors don't have a visibility into incremental revenue drivers. Coming into 23, we knew that they're going to ramp up Reels monetization, they're going to ramp up click to messaging, they're going to ramp up AI, Gen AI related things throughout 23. Into 24, the number of incremental revenue drivers are slightly limited, and we have very limited visibility as to what net new things can they do, or is it going to be more of the same? So I think that's the wall of worry that investors would need to climb about comms getting tougher and fewer incremental revenue drivers. So hopefully we get a better narrative from them around the net new things that they have been investing in. Perhaps it is about e-commerce. Perhaps it is about what they're doing with Amazon and shops on Instagram. So there are new things, but not as big enough as we saw in 23.
Rohit, on that point, and I'm glad you mentioned AI, right? We have transitioned from, all of the calls talking about how generative AI is going to be transformative. It's the biggest thing since the iPhone, is this and that. And now, what is it? I mean, maybe it's still going to be all of that, but we're not seeing that bear fruit as of yet. It's not going to be, that incremental driver that you were talking about. So how should investors be thinking about it when it comes to Meta?
I think, let me get this straight. With regards to Mag 7 and definitely within the internet mega caps, Meta is probably executing on a Gen AI playbook and out-executing its peers better than what we have seen in the other Mag 5 players, if you will. The reason I say that is they have recreated their entire ad stack that has about 10 to 15 million customers, which are their advertisers. And so the scale of improvement that those advertisers will get with Gen AI improvements is going to be amplified, and that's going to help with the fundamentals. They're not doing a lot of external things that we are able to see on Instagram or WhatsApp or whatnot. Those are mostly experiments, but in my opinion, Meta is executing the AI, Gen AI playbook better than peers, and that's something that we are very excited as to how ad stack is improving, and now they're improving on consumers as well. But you're right, I think, Julia, in terms of it's not yet apparent, it's still coming, and that's the amount of investments that they need to do to make it very apparent. That is probably going to be the big question mark tomorrow morning.
Rohit, I'll get you out of here on this. Obviously, a lot of news around TikTok, potentially, good news for Meta.
Absolutely, as in there is no doubt about it. I think the way this is going to be a slow-moving iceberg, in my opinion, or slow-melting iceberg for the next 6-9 months, and then it melts very fast. But over the next 6-9 months, if you're a new advertiser who's looking to spend some resources, time, or money on TikTok, you would be hesitant because what if TikTok goes away in the next 12 months? So the first thing you do is probably go to the next best thing that's out there, that's Instagram. So the first and the most direct beneficiary that we think that happens with the volatility in TikTok in the next 6-9 months, that's Meta, that's Instagram, and then there is probably trickle down to other companies like YouTube and then maybe Snapchat. But Instagram is the best beneficiary next 9 months. Beyond that, it's a much bigger beneficiary.
And Rohit, I know that you're buy rated on Meta. So do you think investors should be stepping in here as the stock falls on this earnings report, or is there like a key question that you need answered on that conference call first?
I think objectively speaking, there is the potential upside that investors thought that this is a company that could show a pathway to maybe $26 per share for 25, maybe $27 per share. I think that is off the table. But having said that, in my opinion, this company definitely does at least $23, maybe $24 per share. And that means that after hours, it's trading at 18 times. And plus, they're going to buy back shares and generate a lot more cash. So maybe they're trading at 16 times, which means we would be stepping in and buying it here. But perhaps the upside that people are modeling, maybe it goes to 550 and beyond, that's going to come down a little bit. But still at 440, it's the best mega cap to buy right now.
All right, Rohit, thank you so much for breaking down those earnings. We appreciate having you on the show.
Thanks, Josh. Thanks, Julia.
Ford shares are rising following an earnings beat on the top and bottom line. Let's get to those numbers, Julie. Q1 results beat. Q1 adjusted EPS 49 cents. Street was at 42 cents. Top line better than expected too. Revenue comes in at $42.8 billion versus consensus at $40 billion. Looks like they reiterated earnings forecast for the year, $10 billion to $12 billion before interest and taxes. Raised free cash flow forecast to between 6.5 and 7.5 billion. You can see the stock's popping here. Heading into the print, we were already up about 6-7% this year, Julie.
Yeah, and it's interesting the breakdown in the different divisions as well. Ford Pro, that's their commercial business. Revenue there up 36% in EBIT, earnings before interest and tax more than doubling. They saw high demand for their Super Duty work trucks and transit vans. Ford Blue, which is the sort of legacy business, if you will, what they've always done, they said their hybrid volumes on pace for 40% full year growth if they continue at the same trajectory, which I thought was quite interesting because we've seen that sort of pivot on the part of car buyers to hybrid here. So that's part of what we're seeing. And the president and CEO, Jim Farley, saying in the statement that he sort of is emphasizing the suite of different choices that they are offering to consumers right now.
Yeah, as EV growth is slow, they've really kind of dialed back their EV strategy. And so now it's about, okay, we're going to ramp up output of the bread and butter, traditional gas models like the Bronco Sport. And to your point, focus on those gas electric hybrids too, which people want. Consumers are still hungry for those.
I mean, the Pro business really a standout here in the quarter.
Sure. Still to come, more earnings to break down. We're going to get you all the numbers for both IBM as those shares are sinking. And then we're joined by an analyst to break down the latest numbers from Chipotle as those shares are higher following an earnings beat. More market domination over time coming up. Let's get you up to speed on the action from today's trade, sponsored by Tasty Trade. And look at the major averages, Julie. It's basically a real muted kind of finish to the day here. The Dow's down about 0.1%. The S&P 500 has basically ended the session flat. Tech-heavy Nasdaq finished it up about 0.1%.
So let's get to some more earnings. IBM confirming it is acquiring software company HashiCorp. That's been reported upon in recent days. At the same time, it's also reporting its first quarter results here. And the company shares are falling, as you can see. Revenue coming in at $14.46 billion. $14.25 billion is what analysts had been anticipating. And the company's operating EPS, earnings per share, that is at $1.68. Excuse me. The company says that HashiCorp buy is going to add to its EBITDA in the first year post the acquisition. At the same time, the company is not really raising its forecast for the year. It is leaving that unchanged. So that's something to keep in mind as well. So the shares under pressure here. It looks like might have been some weakness in the consulting business. And that's part of the reason, it seems, why the shares are trading lower.
Yeah, it's interesting, Julie, because I know there's some on the street, analysts cover the name, and they would argue IBM is kind of a show-me story. And if they're effectively saying, listen, that they actually kind of like what they would see in the software side of the business, the growth, the profitability. Software represents probably it's like roughly 40% of total mix, but I know they would kind of call out concerns they might have about the consulting business.
Right.
So on the call today, listen, there'll be a lot of questions about the acquisition, but also questions about AI, bookings, revenue, overall contribution, Red Hat performance and outlook always in focus. Kind of what the trajectory looks like there, and then that consulting growth and free cash flow too, progress toward that kind of $12 billion outlook there.
Right, and that's something that they did not change. So maybe there's just a point that they didn't raise it, unclear. But if you break it down here, software revenue rose by 5%, consulting revenue was flat, and infrastructure revenue fell by 1%. So consulting revenue, to your point, was kind of the focus here, or the swing, if you will, that people were paying attention to. And that is an area that seems to have disappointed. So hence the decline that we are seeing in the shares in the after-hour session. And when you look at, by the way, how the shares have done as well, they're up about 12.5% year to date. So not like huge outperformance, not huge. They've done better than the market.
Yep.
But it's not like meta-sized returns year to date going into this.
No, for sure. Moving on, Chipotle shares gaining after the company reported its first quarter results, also out. The company's comparable sales beating analyst estimates. Here for a deeper dive in Chipotle's results, let's get to RJ Hadavi, head of analytical research. RJ, it is good to see you. So maybe just get your first hot take on that report, RJ. What'd you make of it?
Yeah, I think right out of the gates, that same-store sales beat was pretty significant, coming in at 7% versus consensus estimates of 5.4%. Our data showed pretty strong traffic throughout the quarter. January was weak just because of weather, but strong results February and March. I think a lot of that comes back to new product innovations that the company released, but also some improvements probably on the throughput side. We saw that in the leverage, the operating margin numbers as well, and that's continuing in the second quarter. So I think really it's that top-line momentum that's really driving that. Not every restaurant operator can say that in this environment, and growth stocks, if you can find some really great stories like that, that's where we're seeing a lot of the market gravitate towards these days.
Hey RJ, it's Julie here. And it's interesting, that operating margin at 16.3%, which was up year over year from 15.5%. And as you say, that's partly top line growth here. How much of it should we also attribute to price? And what is sort of the cost of goods looking like these days?
Yeah, certainly price is an element of it, and the company's running in the low single digit in terms of pricing increases year over year. Certainly below what we seen with the inflation period last year, but certainly an element of pricing going in. So I think that's certainly attributing to it. But I do think if you look at that based on the top line numbers and the typical leverage you would see with that, I think you can also start to look at some improvements. The company's talked about throughput improvements for the last several quarters, and it comes down to better training and better retention. And I think we're starting to see that in the numbers. I think there's still room to go. I think there's still some opportunity there, but that is a really encouraging number and really coincides with the visitation numbers that we're seeing with our data.
RJ, I always love that word throughput. For the lay people among us, what is that? I mean, it basically means like getting your food to you quicker, making the whole process of moving through the line quicker, right?
Exactly. It's for quick service restaurants, it's key to be able to get people through the line quickly. And it's the reason why people are willing to wait in long lines at Chipotle, because they know that they can get through that quickly. And not every restaurant operator has that ability. And so I think that's an important metric. And in fact, there really is a high correlation for those chains that can move people through the line quickly during their peak hours. They generally tend to be more successful longer term. And that shows they have a lot of demand if people are waiting in the line. That shows they've got the operations down pat. And so I think that's something that Chipotle would admit that they could get better on that front. They want to get back to peak levels that they saw pre-pandemic. But I'm starting to see some improvement based on our numbers and our visitation around peak hour right now. The throughput enhancements they're making seem to be paying off.
And RJ, heading into this print, the stock had already enjoyed such a run. It was up about, already 30% this year, 60% over the past 12 months. How does valuation look to you at these levels?
It's one of those cases, again, where, there's not that many growth names in this category, particularly that has the white space opportunity that Chipotle does. The company's talked about 6,000 units longer term and, potentially even higher than that, too, as you start to look at smaller markets and opportunity there. So from a valuation perspective, I would just say there is still a lot of growth involved with the stock. And our visitation data, particularly in these smaller markets, shows that a lot of white space. And so I think that's one thing you got to keep in mind with a valuation perspective here.
So what you guys do there, among other things, at Placer AI, is look at those visitation trends that you talked about, the traffic trends. Yeah. And I'm curious if you're seeing across fast casual and QSR overall increases in traffic, or if it is really idiosyncratic chain by chain or even market by market. Can you kind of talk big picture about what you're seeing?
Yeah, very wide range. In fact, we've got most of the chains, both QSR and fast casual were down in January. And again, that was largely weather related. But then we looked at February, March, we were looking at, flat to slightly positive for most of the QSR and fast casual category. And to come in, our estimates put it somewhere in the low to mid-single digit in terms of transaction or visitation growth for Chipotle. So they're doing a lot of things right. They're beating the category by a sound amount there. And so I think it's not just, the growth itself, but it's that outperformance we look relative to Chipotle's peers. And again, they're doing a lot of things right. It's the Chipotle to be able to do the digital order and pick up. It's moving to smaller markets. It's the throughput enhancements. It's the loyalty, the digital platform engagement with customers there. They're doing a lot of things right. And to be honest, not everybody's putting that same investment in this category. So a lot of initiatives they put in, we're seeing, and that shows up in the results that we saw today already.
And RJ, I'm curious, who is the Chipotle customer? Do we have line of sight into that demo, RJ? And is that a more, relatively resilient consumer?
It is. When we look at our data, it definitely skews toward a higher household income consumer. Relative to countrywide averages, it's generally pretty high in there. And so it's not a surprise that this has been a more resilient customer, particularly with inflation and other headwinds coming in. But what is surprising, the company's talked about this too, is they're starting to see visitation increases across all cohort groups from a household income perspective, and that's what our data is showing as well. So encouraging that we're starting to see some stabilization among particularly that lower income consumer. There may be other factors at play too. We're starting to see return to office become a bigger factor that's driving some of that, particularly for the lunch day part in terms of visits here. As I mentioned, smaller markets is also something that's big for these guys as well. So, that core customers tends to be a higher household income. It's generally a little bit younger than say a casual or fine dining. But we're kind of seeing consistency with the visitation trends across different cohort groups at this point.
RJ, finally, I want to ask you about wages, right? And I know you're focusing on traffic and visitations right now, but especially what we're seeing happen in California with wage increases, what effect do you see that having on not just a Chipotle, but any of the big restaurant chains?
It's a great question, something we've been looking into a little bit more. Honestly, with the wage increase only kicking on April 1st, we only have a couple of weeks of data to look at this point. Generally speaking, what we've seen is that California as a state, as well as key markets in California, that'd be Los Angeles, San Francisco, San Diego, are generally just tracking off a national average at this point. We see it slightly behind. There is admittedly a little bit of noise in the first part of the month with Easter travel and things like that. But generally speaking, it is lagging, and I think we're still in that adjustment phase. A lot of consumers are coming in and maybe hadn't seen any kind of price increases because of the wage increases too. So it's something we're going to be actively monitoring. It's something that's a little early to tell. Just like I said, they're slightly off national averages right now in the state of California, but I don't think it's enough to make any direct inferences at this point. We're going to need a little bit more data on that.
RJ, thanks as always for joining the show. Appreciate it.
Thank you.
And tune in tomorrow. We're going to have an exclusive interview with Chipotle CFO Jack Hartung in the 9 a.m. hour of Yahoo Finance. Time now for What to Watch Thursday, April 25th, starting off on the earnings front with two magnificent 7 stocks in focus. Microsoft, Alphabet, and Intel all reporting tomorrow. Microsoft announcing third quarter results for 2024 after the bell. Analysts expecting the tech giant to continue its strong cloud sales and AI improvements to Azure workloads.
We'll also be getting some airline earnings tomorrow from Southwest and American, both reporting first quarter numbers before the bell. Analysts expecting fuel and labor costs to be a factor for both airlines. Higher fuel costs are likely to bite into Southwest's earnings, and American Airlines is facing the challenge of a new contract approved last August that will increase pilot pay.
And taking a look at the economy, first quarter GDP data is coming out tomorrow morning. Economists forecasting economic growth to slow down compared to last quarter's unexpected gain. New report giving us more insight on inflation as the Fed continues to ponder interest rate cuts.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow, 3 p.m. Eastern, for all of your coverage leading up to and after the closing bell. Stay tuned. We've got more Yahoo Finance on the other side.
It was another seesaw day on Wall Street while stocks closed off the lows of the session. Higher bond yields weighed on investors. Joining us now is Christian Magoon, Amplify ETF's CEO. Christian, it's good to see you. So Christian, we had the pullback, but you say, look out, this could actually turn into a full-blown correction. How come, Christian?
Yeah, I think, the market really is digesting what's going to happen with rates here. And, we've taken a lot of cuts off the board, maybe one expected. And, data kind of is coming in hot here for the economy, which is, I think, pretty good for a long-term for investor. But for investors betting on rate cuts, that could cause some more issues in the market. So while we think this dip could be a little bit more pronounced than 3-4%, maybe closer to 10%, we think this is probably a good longer term buy the dip situation because, of course, we're in a presidential election year, and some of those cycles show that, the end of spring, early summer are weaker, followed by a fairly strong fall. So we think this could be a buy the dip opportunity, could get a little rougher here, but we do think there are places to maybe hide out, for example.
Okay, so give us some of those places where people can hide out. And presumably you're talking about hiding out maybe while this correction that you see is happening.
Yeah, that's right. Yeah, and there's different kind of forms of that, right? So one of the areas that we've seen do quite well in the last month with the S&P down 3-4% is silver, and specifically silver stocks. So the S&P down 3-4%. We've seen our junior silver miners ETF SILJ rally by 17%. So about a 20% performance difference just in the last 30 days between junior silver mining stocks and the S&P, really due to a couple factors. Some of it is the increased debt burden. There's been some reports out about record silver use industrially in 2023. The price has risen on silver, but there's probably, we think, more to go there given the current environment. So we think looking at those silver stocks may be a nice little way to grab some alpha here while the general equity market tries to digest kind of the future.
What about oil, Christian? You want exposure there as well?
Yeah, we think so. Oil certainly is very volatile right now, given recent events. There's a lot of exogenous events affecting oil, be it geopolitical conflicts or even some of the Cold War issues going on with the U.S. and the SPR. So we think owning oil, though, is a great thing for investors to benefit from. These higher than average oil prices, even after we've come off the peak, equal larger profits for oil, gas, chemical companies. And many of these companies are pivoting and saying, you know what, we're not going to spend all the money on R&D like we did in the past. Instead, we're going to return capital to shareholders. So they're increasing their dividends. They're doing special dividends, stock buybacks. So we think looking at a portfolio of high dividend yield, oil, gas, chemical companies makes sense. We have NDIV, NDIV, our natural resources ETF. Yields well above 5%. We think the yield could be closer to 8 to 9% with special dividends coming in later in the year. We'll have to watch earnings for these oil and gas companies to see. But again, elevated oil prices are good for the bottom line here. And in this case, it really helps with shareholder returns.
And then you guys actually run an Israel ETF, which, seems like it would be kind of a counterintuitive play right now with the geopolitical risk.
Yeah, it's definitely for perhaps a more of a longer-term investor or contrarian investor portfolio. This is ITEQ, ITEQ, the Israel Technology ETF from Amplify and Blue Star, is a fund that's been out for nearly 9 years. It's averaged 9% a year, average annual returns going back to 2015, and it invests in the companies that are really innovative, that are coming out of Israel. And these are cybersecurity, artificial intelligence, clean energy, agriculture companies, very cutting edge companies that are trading at a meaningful discount right now because of several of the things. Yes, the Hamas conflict, but also before that, there was the judicial controversies in the Israeli government. And this has really pushed these companies down. Now they're above where they were as of the October 7th attacks, but we think they could be a great play for the longer term investor. If you look at geopolitical conflicts in the Middle East or Israel, investors benefited from buying the dip in Israel equities in general, and certainly even more so looking at these technology companies. So we think ITEQ is a great savvy way to get involved. These companies are trading at 11% discount to their price to sales ratio over the last 7 years. And again, with the portfolio averaging 9% a year going back to 2015 average annual returns, we think buying this on a dip makes a lot of sense for long-term investors who want exposure to maybe more moderately priced technology stocks and are willing to stomach some of the headline risk and increased volatility that hopefully will dissipate over time.
So Christian, silver, oil, and Israel, we're putting together an interesting portfolio.
Yeah.
I'll get you out of here with this, Christian. Give me, is there a sector though, or an asset you would avoid here, Christian?
Well, that's a good question. So I think looking at the artificial intelligence stocks here, or semiconductors, is something that you'd want to pare back from. They've had a great run. They've had tons of momentum, and certainly we've seen them drop off. We think breadth in the marketplace is going to broaden, and if that's the case, less money will be chasing these names, more money will be chasing maybe some of the higher quality growth companies or other sectors beyond just technology and in industries like semiconductors. So we think taking some of that exposure off and looking at other areas that are maybe more moderately priced that haven't had this type of incredible run makes a lot of sense here.
Christian, that was a great chat. Thanks for joining the show. Appreciate it.
Hey, good to see you. Thanks for having me.
Up next, a look under the hood at the commercial real estate market as part of Yahoo Finance's week-long special, Real Estate, the New Reality. We're dissecting it all when we come back. Tightening spreads and debt worries tainting the look of the commercial real estate market this year. But our next guest says fundamentals for the market are sound. For more on the bright spots and storm clouds of the commercial real estate space, let's get to Marcus & Millichap CEO Hessam Naji joining us here as part of our week-long special, Real Estate, the New Reality. Hessam, it's good to see you. And maybe, we talk about CRE a lot on this show, and maybe we'll just start there, Hessam, kind of your 30,000-foot view of the sector. How healthy and resilient does it look?
Good afternoon. Thanks for having me on the program. We really have to separate the property fundamentals and property performance from the capital markets, interest rates, and valuations. On the property fundamental side of the equation, the industry as a whole is running something in the neighborhood of 90 to 95% occupancy rates, except for the office sector, and is not seeing a massive overbuilding problem or rent collection problem or any kind of a reversal in healthy occupancies. What we are seeing is pockets of overbuilding for apartments. We're definitely seeing pockets of overbuilding for warehouse distribution facilities, which has been really driven by a lot of e-commerce growth over the past 10 years. And other than those two, there is really no signs of any kind of a performance concern or occupancy concern. The office sector is a whole different story. And even there, we have newer properties, especially in suburban markets, that are running on average 11, 12% vacancy rates. And then there's urban office, especially older ones, that are running 25 to 30% vacancy rates. And those happen to get a lot of the headlines and a lot of the focus because of hybrid work solutions and people being reluctant to come back into the office full time, which are legitimate problems. Many of our clients are reporting continued headwinds against getting people back in the office. But it's really limited to urban office, especially the older stock of office buildings. On the capital markets, interest rates and valuation side of the equation, we're still seeing a big bid-ask spread between buyers and sellers and reluctance by banks and credit unions to be actively lending in the market. So that is still the most the biggest area of challenge.
And Hessam, I noticed that the group, in terms of sentiment around the stocks, has not been great. That's true of Marcus & Millichap. That's true of real estate investment trusts. It's really true writ large here. And do you think that sentiment basically has to do with what the outlook for interest rates, and that perhaps the stocks can't recover until we get a little bit closer to when we might actually see cuts?
That's a great question, and there's a direct correlation between the groups, the entire sector's valuation movement, and Fed sentiment. We saw a big run-up in the sector's valuations late last year when interest rates were coming in. The 10-year Treasury had peaked around 5% and then pulled all the way back down to 4%, and you saw the stock prices go up accordingly. And then when the Fed basically changed its mind again, given the inflation readings of the last couple of weeks coming in hotter than expected, and now the notion of delaying the easing cycle, you see the stocks are under pressure again. So there's a direct correlation between Fed expectations and interest rates because of the fact that the cost of debt is such a paramount element to evaluating commercial real estate. The vast majority of transactions use debt in some form. Typically 60 to 70% of the value of an acquisition has been financed, whether it's banks, credit unions, insurance companies, and other forms of lenders, the CMBS market and so on, agency lenders for apartments. And therefore, the sensitivity to the cost of debt has a direct correlation on pricing. And it's not a surprise to see that tight kind of band.
Hessam, I'm curious, when you're talking to your clients right now, what are they most interested in? Where do you see the strongest demand?
It's interesting. There's been so much focus on the Fed, and everyone, at least psychologically, still waiting for the Fed to break the cycle of tightening and introduce the cycle of easing. And there's a lot of kind of dependency on that timing and the shift for when people, I think, are going to become much more aggressive in coming into the market. Meanwhile, what's interesting is that 2 years has now passed since the tightening cycle, and that time frame has brought price corrections, has brought some distress, operational distress, not so much, industry-wide big sell-off of major portfolios, but operational distress in many different product types and markets. And therefore, more properties are coming to market at prices that are far more reasonable. And they're very competitive with replacement costs. One of the most important metrics for commercial real estate investing is replacement cost. And so a lot of our clients are actually seeing that replacement cost is not much higher than the price they can fetch current assets. And therefore, they're moving ahead even before the Fed really confirms its intention to bring down interest rates with the first reduction. So we're seeing more activity. We're seeing more properties come to market through exclusive listings because those sellers that were waiting for a Hail Mary from the Fed are now seeing that that's not going to come. And interest rates are, even when they start to come in, they're very unlikely to go back to where they were, which was near zero for quite a long time. So there's a whole recalibration and adjustment in the marketplace that's happening as we speak. It just hasn't quite finished its process yet.
Hessam, great to see you. Thanks for joining us as always.
Thanks for having me.
Coming up, plenty of earnings we've still yet to talk about. We're getting you the latest numbers from ServiceNow and Whirlpool on the other side. Let's take a look at what's trending after hours. Shares of ServiceNow are sinking after the software company's sales outlook for the upcoming quarter came in below estimates, suggesting corporate customer budgets remain tight. But it was a solid first quarter for the company. Profit more than doubled as AI-enabled software sales soared, and ServiceNow did beat on the top and bottom lines.
Also taking a look at shares of Whirlpool here, getting a boost after hours. The company is cutting roughly 1,000 salaried positions in an effort to reduce costs as weak U.S. home sales weigh on demand. Revenue for the first quarter beat analyst estimates, but sales of large appliances in North America fell more than 8% from a year ago.
And that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern, for all of your coverage leading up to and after the closing bell.